Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists. Giles Gale, Head of European Rate Strategy, John Briggs, Global Head of Desk Strategy, and Theo Chapsalis, Head of UK Rate Strategy. Hi everyone, welcome back to another Bondcast. A busy week this week. We had, we're recording this on Wednesday, so we had some big market moves yesterday. On Tuesday, bond yields were up quite a lot and equity stocks down quite significantly. So before I get into this week's moves, though, it feels like a while ago now, but we haven't done a podcast since last week's NFP print, John. So that was a huge miss versus expectations. We had Bloomberg consensus around 1 million, but I think people were even talking about higher than that, and some people suggesting as much as 2 million. And the number came out significantly lower than that. I think I read somewhere, or even you told me, I think it was the lowest or the biggest miss since 1998. Maybe I've got that wrong. You can correct me.
Yeah, perhaps even longer, I think.
Even longer, there we go.
Long time.
Yeah, a long time anyway. So, and there's been a lot of debate since then about whether that really is just noise. And we've had data since then that might suggest that it is, and we can get onto that. But where do you sit on this? Is this, an important signal, or is this really just a noisy data print that we shouldn't read too much into?
Yeah, I mean, I'm kind of falling into the camp where it's more of a sign of labor shortage rather than lack of labor demand. I mean, as you said, we've had some data. I mean, just yesterday we had this JOLTS report, which is the job opening and lever. I forget what the TNS stand for, but job openings and levers basically. And it showed that job openings, firms looking to hire, is at the highest level in, decades. So there is a lot of demand for labor. There's lots of issues going around with labor supply, and there is noise in the data anyway. I mean, you've got seasonal effects. You've got issues with the fact that you're coming out of a pandemic, which is something that the BLS is going to have a very hard time to adjust for, as it's a historic type event. But there's lots of kind of little reasons that we're looking at as to why labor supply might be not meeting demand. And some of it is unemployment benefits. Is that keeping people at home? Some of it is probably childcare issues. If you're reopening workplaces before you reopen schools and childcare, that may not matter for a lot of people that can't go back to work. There's still fears of COVID is still, an important item. A lot of the demand is for service sector frontline things that are reopening. There's still a lot of demand for grocery stores, but restaurant workers, service industry, hotel, travel, that kind of thing that's picking up. But those are frontline, and they're not typically the greatest paid workers. So if you take some of those reasons, if you're getting unemployment benefits, you're worried about COVID, and you're getting a low wage, then the motivation to come back could be low. Now, do I have the exact answer of which of these is greater, or if they're solvable in the near term? No, I mean, I think that we also have to keep in mind that just because forecasters thought it was 1 million and we only had some 200,000, doesn't mean that it's a bad number. It's just that the forecasters kind of got it wrong too. So, it definitely was weaker than expected. I'm not dismissing that. But I think there's some factors here that hopefully will prove somewhat transitory. And we should, and markets are fickle. If we have a strong data point next month, we're going to forget this as an aberration. But I do have to be fair. There is a camp out there that thinks that they're slowing in momentum in the reopening. And this number definitely gave them some ammunition, because while all the other data out there has been very strong, retail sales, consumer confidence, today's inflation print was pretty strong. Surveys, NFIB surveys, hiring intentions, all this stuff is really strong. Things like ISM and ISM services, while again at high levels, are coming off their peaks. So you could make an argument there's a loss of momentum. That's just not where I fall.
Okay, so I guess following on from that, my next question would really be, what does this mean for the policy response? I think part of the response that we saw immediately after that weak NFP print was people jumping ahead to thinking about what this could mean for more fiscal policy and, more money coming in, if you like. And now, like you say, we've literally, just as we're recording, have had that huge beat on inflation. So we're talking about a massive miss on the jobs numbers last Friday on NFPs, and then missed to the upside on expectations on inflation. What does that mean for the Fed? Like, how do they kind of trade off the two, and where does that leave the tapering discussion, if you like?
Yeah, not the best run for U.S. consensus forecasters, that's for sure. Yeah, so two things you mentioned: monetary and fiscal. I mean, starting with monetary, as listeners know, we're always in the zone where we feel like the Fed's going to start talking in September about tapering. So the market was going to start discussing it kind of in the summer months. We were trying to get ahead of that and position for that, which I'm sure you're going to get to in a minute. But market talk had started to move that up to June, that maybe the Fed starts to signal in June, maybe they start to think about or start to discuss in speeches earlier that they could start to consider tapering or putting it on the table for Jackson Hole in August. I think that now with this number, the payroll number, even with today's CPI beat, that conversation, the hurdle is going to be high there, because the Fed has made it very clear that high inflation they expect to be transitory. This is obviously a lot higher than what the market and probably the Fed was looking for, but I think they'll be patient with that. But at the same time, they're going to need to see if employment is going to pick back up, because again, that side of the mandate is really the one that they're leaning on. They're willing to tolerate above target inflation over time in order to get the unemployment rate down. So with the unemployment rate actually ticking up a little bit, they're going to be patient in that. So I think as we look ahead to the June meeting, just at least from here, we expect a lot of the same rhetoric from the April meeting, which is, we're wait and see, it's too early to talk and that kind of thing. So, again, that pushed out some building expectation. I wouldn't say it was by consensus by far that the Fed might start talking about it in June. We think that hurdle is very high.
Sorry.
No, I was just going to say on the fiscal side, because I think that's important, as when you look at the actual market reaction was on the payroll day, is that yields fell, but then it ended up having, from the after print move, a bear steepening move. And, 10-year yields were unchanged. The front end was a little bit lower in yield. But why? Because that was, a weaker number. But I think that also spurred, as you said, some expectations that this might motivate that infrastructure spending. It might motivate perhaps a little bit more on the fiscal side if the labor market's slowing down. So, I mean, I don't think it changes it that much, to be honest. Perhaps if next month, this week also, we could see more. But there is a little bit of a building, okay, well, maybe if we are slowing the momentum, fiscal is going to come back. So bad news is good news.
Okay, so if we have this, view now that the Fed are going to start pushing back, or at least June will be too early to start thinking or talking about tapering. And, we've talked many times on this podcast about our bearish view and the fact that in the US specifically, we hold that at the 5-year point because we think that the curve can still price in more rate hikes once we do start to get to this kind of taper discussion. Does this push back then your timeline for when you're thinking about meeting those targets that we have for that short 5-year view?
Yeah, I mean, it certainly doesn't accelerate it, but I think that for us, we were trying to get ahead of it, and clearly, this number makes it look a little earlier than we would have liked. But that said, the market price action, for example, we initiated our recommendation to sell or underweight 5 years for around 80 basis points, and we went down to 75, 74, and then ended the day right back kind of around 80 basis points. So I think that, part of the reason why we chose to do it now was, the entry level and location being that there was very little of that Fed pricing. But we also knew it was going to be a multi-month issue, or a multi-month, as we see when this plays out, as we head in towards the fall. But I have to say, that number on its own definitely did mean that we would probably have to wait another month. In other words, what is the next payroll report? Is the market going to get really aggressive about pricing in rate hikes? I mean, really aggressive within a scale of things. We're not talking about massive amounts of rate hike pricing, but there's just so little here. We think that the belly is going to weaken as the market starts to look forward to taper, and then build in some probability that we get rate hikes in the out years. So clearly that has been delayed a little bit, although we still believe that we're in that part of the cycle, that we're in that part of, the process where you steepen the curve. And then as we start building rate hikes, start to weaken the belly and then eventually flatten the whole curve. We're not quite in the flatten the curve yet. That's going to be probably next year's business. But as you mentioned, we just had a very big CPI report, minutes ago before this recording. And that does seem to be causing a little bit of a reaction here where you're pricing in a little bit more of rate hikes in the way. I mean, it's still very early in reaction, but the belly's weakening up. We're actually flattening the curve a little bit, 5s to bonds, 5s to 10s. So that's not a, oh my God, there's inflation coming. There's a, well, maybe we should think the Fed, if this inflation continues, is going to respond. So it also shows that the market does think that while the Fed's reaction function is going to allow some higher inflation, they're not going to tolerate, this kind of higher inflation. So you do have a little bit of a seesaw here between some of the data of late, big misses, but causing a different reaction.
Yeah, sounds like there's going to be, much more than usual, I would say, attention on the NFP print next month. So I'm sure we'll be discussing that on this podcast in a few weeks' time. So in Europe then, Giles, because, I mentioned at the beginning of this podcast that yesterday, so on Tuesday, we saw some very big market moves. I think in core bond yields in Europe, it was the biggest one-day move that we've seen probably since the beginning of March, and stocks were significantly lower across the board as well, led by tech stocks. And one of the things that we've talked about, I'm not sure if we've talked about it a lot on this podcast before, but we've certainly written many, many notes around it and had many client discussions over the past year or perhaps even longer around this idea of the kind of death of the macro hedge and the fact that bonds no longer really offer much of a diversification value in a balanced portfolio. And we've been talking ourselves recently, I guess, about the risk scenario of this kind of everything down move in markets, bond prices lower and equities lower too. And so I just wanted to kind of pick your brains and understand how concerned you really are about that. And particularly, I guess, in the context of a European central bank who is using easy financial conditions as their kind of compass to navigate them towards price stability, as they say, and obviously significantly higher bond yields and lower equities will tighten financial conditions to a point that I would imagine they start to worry.
Right. I mean, yeah, it's a huge question, this one, but you're absolutely right to say that it's something that we highlighted a year ago. And I mean, I suppose it was always likely to be a pretty slow burn theme. But I mean, from our perspective, it's always been one of the arguments that we present when talking about the sort of long-term factors that we see driving bonds lower, as in yields higher over the next, call it year, 2 years, something like that. And it was always really focused on the bond side of the equation. I mean, it was never really a strong argument that what needed to correct was necessarily stocks. The idea was just that the case for aggressively continuing to rebalance portfolios. I mean, we see it particularly strongly, of course, in the US with, when US stocks do very well, then there's constant pressure to sell, to buy treasuries. Now I'd say that that's somewhat less of a dynamic in Europe, but there certainly has been a sort of over allocation in a way to high quality fixed income. And bunds, they've had their sort of special kind of flight to quality sort of role in portfolios for quite a long time. And the idea here is, just as people realize that not only a priori should correlations be less negative, and so that is the diversification value of fixed income just be less. Actually, that is something that you can see in the market actually happening. And I mean, as we talk today, of course, I mean, the classic way that this happens is that you have higher inflation pushing yield levels higher, but that also causing concerns about risk assets. And I mean, it's not happening in a especially dramatic way today, but it's certainly been a theme of this week. And I think that if you run the historic data, you'll see that the correlations are historically high, and in fact, in the case of the US, they're positive, which is pretty unusual. And I do think that that's the kind of thing that should continue to inform, I guess, the very highest level sort of strategic discussions about how people want to approach their investment in fixed income. So, that I suppose is one answer. I suppose the second answer is, well, to the extent that this is all about inflation, I mean, I suppose that the European inflation story is a little bit less clear. I suppose that the assumption is that if it's happening in the US, then it'll come here for the same reasons, and that's certainly the story that we've been saying for quite a long time. But I suppose that the expectation will be that as long as there's any uncertainty at all, central banks will be the absolute last among us to recognize that there really are inflation risks that require a reaction against it, and that ought to keep at least I guess risk assets somewhat underpinned.
We talked a lot last week about switching to our bearish view and the fact that we're all in again on that long-term bearish view. And obviously we've seen, like I said, significant market moves this week and bond yields significantly higher. Are you now worried that this is becoming a more consensus position? Is that the sense that you're getting from, I don't know, discussions that you've been having with clients or elsewhere this week? Are you worried basically about positioning in bonds yet?
So it's a bit of a live discussion. I'd say not that much. I think that our client discussions have been more balanced, and some of our salespeople are certainly sort of feeding back that sense more than they have done over the year to date. Is that a worry? Obviously, you never want to be the wrong side of a crowded position. I don't feel like it's crowded. I just feel like it's more balanced, to be honest with you. And I don't really see why a moderate sort of short-term focus on this can't be absolutely vindicated by signs that our more bearish base case, which, just to remind you, means essentially that we continue to open up the economy in Europe, roughly on the time frame that we have in mind, sort of between now and the end of June, middle of July, that sort of thing. That the summer is not going to be a disaster, that the data continue to be reasonably good, and the data has been pretty good. I mean, last week it was we had quite a few decently strong indications on things like industrial production, industrial orders and investment intentions. This week we've had the ZEW index from Germany. That's a survey of investment professionals. We've had pretty strong Centix indicators. So everything's kind of pointing in the right direction. And I think, as I say, firm base case is that the recovery story is vindicated. In which case, I don't see why a moderate build-up of positioning shouldn't be something that can be worked out into the broader market over time, and it doesn't have to be a problem.
Let's hope that's the case then. It'll be interesting to see. This is a topic of discussion, I think, for the next few weeks, because it's not imminent, but it will be interesting to see how the ECB kind of deals with the I guess trade-off between having much better data, but also obviously that coming with the higher bond yields that we've seen over the past few weeks. Okay, so Theo, then, given that we have just had this big miss, stronger than expected. I think miss has a negative connotations, but much stronger than expected US inflation. And as I know, inflation is your favorite subject. Let's start with that before we talk about the UK this morning. We talked this morning about the fact that market expectations were already very high for this inflation print, and this has come in even higher than that. So where does that leave you on your US inflation view? Because you were in those kind of front or 2s, 10s swap steepeners in the US. Do you still like those trades now? And how has this print changed your view potentially?
Yeah, absolutely. So this is, I think, the most important number and the most important figure definitely for the week. I mean, we've seen obviously positioning in other asset classes, and we've seen fear specifically in equities ahead of this print. The reaction is very interesting. So clearly there is some support for front-end inflation. Clearly, the idea that higher inflation is coming is vindicated. So there is no doubt with regards to that. The question is to what extent this is a print that came stronger, and then other prints in the next months just stay at a similar level because inflation came earlier than expected, or does it mean that we are on an upward trajectory? And the price action so far is that it is the former, i.e. it was a very specific print that came stronger. Clearly, if you have steepeners, so if you have the CPI steepener view that we had, it's not great, obviously, because this is an inflation bearish trade, and what we got today was, an inflation upside. So we can't win all the times, right? So, but to be fair, what does it mean for the market going forward? It means that we have a level of expectations that is already fairly high. And it means that also the bar has been set fairly high again for other prints to surprise the upside. So this is what I keep from here. And this is also why the price action is fairly orderly given the magnitude of the upside surprise. I don't remember in the last 12 years that I'm in the market, I don't remember ever such a big surprise. And I don't remember also such a strong price action at the front end of the tips curve ever. I do remember the tips market tank by 10 basis points easily, and I can give you many dates, but I don't remember the tips market at the front end rise by 10 basis points. So this is, I think, definitely something to remember. It's, of course, it's big news, and it is a surprise, and it's not in line with what I've been expecting and what many of us have been expecting today. But I think it's a bit of a mixed bag, so it's not totally a negative signal for risky assets.
So sticking with inflation, but switching gears just to think about the UK now, because another kind of interesting price action that we've seen this week is this, correlation between UK inflation and sterling. So we've had sterling perform quite well, I guess, this week with the risk events of the Bank of England last week, and then obviously the Scottish election over the weekend now being behind us. But also, the global inflation trade has been on this week, and the UK has participated in that. So what are your thoughts around the correlation between those two asset classes?
Yeah, definitely. I think it tells us a lot about the validity of hedges and the way that one should regard different hedges. So it goes very well with what has been mentioned earlier with regards to fixed income, for example, and how this fits into broader portfolios. Inflation portfolios used to be very often hedged with sterling, so short inflation positions in the UK with short positions in sterling. So if you were to have lower inflation, that would happen with a higher currency. So this is how the market did operate for at least 5 years. But right now we see the opposite. Right now what we see is support for commodities, support for risk, pretty much pushing sterling high and pushing also inflation expectations higher. So the two move in the same, not in the opposite direction. So we cannot, obviously this doesn't work as a hedge. It is very interesting what is going on at the front end of the UK curve, because some of those forwards have gone up, and they have gone up even though the UK and the BOE, they are not adopting policies that are similar to the Fed. I.e., we don't have flexible average inflation targeting. And yet, we talk about forwards in the UK that in RPI terms will be very, very close to 4%, sub 5 year. And if we are to adjust for the RPI reform in that 10 to 15 year sector, we talk about RPI forwards in the 4.3% area. So expectations are definitely high in the UK as well.
And then just rounding off the discussion, so we've kind of ticked every asset class there. If we come back to just nominals in the UK, I want to ask you the same question that I asked Giles, which is around positioning. And, again, in the UK, we've had this long-term bearish view, which we've discussed on this podcast many times. So how concerned are you about positioning in the UK at the moment? Is this short view very consensus now? Are you starting to think about taking some chips off the table given the move that we've had, or do you still think that we're being bearish is the right way to be and there's still a lot further to go?
Yeah, absolutely. I think the way that this is probably the most important question, I would say, for the UK market right now. So how are we? How has the consensus shifted? And definitely, this consensus has shifted to the bearish spectrum, no doubt. And you're right to bring it up as a point. Am I personally more concerned than at the beginning of the year? Absolutely, I am. Simply because I have company now, and others like also that view, which makes me very fearful. We target 1% in 10-year yield, so it is a matter of, call it 18 basis points. So I think that this is something which puts us at the moderate bearish end of range. So it's not an aggressively bearish view. So it is a significantly bearish view, but not ultra bearish. And when it comes to the long end, we are even less bearish. For example, 30-year rates, we target there 1.5%, which is around 12 basis points from where we are. So yes, there are reasons to be bearish because of what happens to global inflation and because of the merits of fixed income. Frankly, even traditional bond bulls, and I consider myself also a bond bull, well, we find ourselves in a position where we struggle to find arguments like the market. So clearly there is a reason for fixed income to cheapen, but there will be a lid simply because, especially in the UK, we know that there will be significant asset allocation flows out of equities into fixed income at some point later in the year. So the theme of de-risking will take place, in which case there is a lid to how high duration and yields can go, simply because, well, there is a buyer that will actually buy, and it's a structural buyer, it's a quality buyer. So this is something that we need to be aware of. So yes, we're bearish. Yes, we are a bit concerned that the view is definitely more popular than early in the year, but we think still there is potential for yields to go up because the fundamental backdrop is very bond bearish.
Right, sounds like that could be a theme to return to then in the second half of this year. All right, thank you everyone for joining me today. It's a lot to discuss this week and hopefully lots of interesting things to talk about next week as well. Have a good week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.